Welcome, everybody, to the Deconstructor of Fun podcast. I'm your host, Mishka Katkov, and we have an honored guest, Mr. Chris Petrovic, Chief Business Officer and Board Member at Fun Plus, talking about mergers and acquisitions. Not talking about, giving a masterclass about mergers and acquisition. Chris, welcome to the podcast. Welcome back to the podcast.
Thank you. I'm honored to be here.
All right. Let me give a proper intro of you, because I know you're a modest person, a humble person. You live in the mountains of Switzerland, so you don't want to talk too much about yourself. Can I introduce you?
Please.
All right. So, Chris Petrovic, you, before joining FunPlus as Chief Business Officer and a board member, you were Senior Vice President and Head of Corporate Strategy, M&A, and Business Development at Zynga. And this was the time when Frank Gibeau and the crew took over, and Zynga went from about a little bit under $2 to, I think, $10, ending up with an acquisition of Take-Two. And I think you had objectively, you had a big role to play in this transformation with an acquisition of Gram Games, Small Giant, Peak Games, and Rolik. So quite the ride, several big deals. We're going to talk about those a little bit later on. Before Zynga, you were a Senior Vice President, Head of Corporate Strategy and Development at Kabam, working with my adopted uncle, Eric Kress, angry uncle.
Everybody's angry uncle. That's right.
Before Kabam, you worked at GameStop as a Vice President and General Manager of Digital Ventures. And you have a storied career. You're a mentor, advisor, board member at such many companies. But one stands out because I'm a little bit of an older gentleman over here. You're a VP of Digital at Playboy. So we can talk about that during this podcast, like the full podcast, or just move on and talk about M&A. But I think most of the audience is mostly interested in M&A.
Absolutely. Agreed.
All right. And Bob, so your colleague, Bob, was here in Helsinki last night because we're recording after the Pocket Game Connect. He told a little bit of a rumor. So he said that when you're walking the mountains of you like hiking. So when you're hiking the mountains of Switzerland, you listen to something. And I thought that when you're walking, you're posting those nice pictures and you're walking them. I thought that you must be listening to country music. That's the only thing that you would be listening, right?
No, actually, no. If what he says is true, then you will be flattered to hear that I do my catch-ups on the weekend of the Deconstructor of Fun podcasts. Yeah.
This is funny.
And the funny part is, too, is I end up rage texting Chris while I'm listening to it. And I'm always on the verge of throwing my phone off the mountain for some of the commentary that I hear.
So we're ruining those beautiful hikes around the Swiss Alps
that makes me go faster.
I got it. By this nonsense podcast. I mean, not Twig is maybe nonsense, but this one is pure gold. So without further ado, let's start talking about mergers and acquisition. And I think the most basic first question is, why do companies engage in mergers and acquisition, especially since we know that the number of deals that are successful over time is between 10 to 30%. So very high risk endeavor. So Chris, why do companies do this, or especially gaming companies?
Yeah, it's a great question. I think if you look at the history of our industry, not just in mobile, but beyond, the history of our industry is built on the foundation of bringing in new blood and innovative businesses through M&A. And I think that's a theme that permeates not only in our industry, but in other, I would call creative endeavors or R&D heavy industries. So, you use as a proxy the entertainment industry. A lot of investment, a lot of mergers and acquisitions of studios, of developers, et cetera. Same thing in the medtech field, like a lot of R&D based acquisitions and a lot of similar deal structure. So I think whenever you're dealing with R&D intensive environments, where there's just a natural inertia towards smaller, more nimble companies that are creating innovative products and services and able to do so in a way that larger companies can't. It's attracted to larger companies. And then on the flip side, the smaller companies get the perceived benefit of the 1 + 1 = 3 calculus that you hear about, which is being able to benefit from the scale, the experience, the financial might of the acquirer that can help you accelerate your vision even more. So that's in theory what drives a lot of the M&A logic in our industry and in others.
So there's the theory, and actually we had an event yesterday, a happy hour event, and there were, of course, a lot of founders asking, like, "How do I get acquired?" Like, I would know. So correct me if I correct
Well,
me
you
if I'm
went through a
wrong.
process, so I think it's valid that people ask you. Yeah.
Well, okay, yeah, maybe, but correct me if I'm wrong. If I did the um, right answer to them. So I said there's five reasons why a company would acquire another in gaming.
Mm.
Uh, the first one would be that you're buying revenue. So you have a nice top line revenue you're putting into this other company, and if the bigger company has a good profit margin, then maybe those two together, can look even as a much stronger entity, even if the other one has scaling maybe not so profitably or even unprofitably. The second reason would have been profit. So you're buying a company that is just very profitable, and you might be the one whose profit margins are not that high, and together it kind of looks very nice. Or you're just buying a cash cow, like Peak Games. And the third one would be an audience. So you're buying a specific audience. It might be an affiliate audience that fits really well with your core games, and maybe you're using already, or you're running a lot of ads in their game. So let's say you have a puzzle game company and they have a word game, and you're seeing a lot of affinity of the audience. So you're making an audience buy. The fourth one was acquiring expertise. So let's say you're a casino company and you want to go into a casual gaming company, then you're into casual games and you're acquiring a developer that has an proven expertise in a specific genre. And then the last one is you're placing an early bet. So it's a startup. It's something that they have a cool tech, they have an interesting team, something small. But those were basically the five reasons. And of course,
Mm-hmm.
they're not mutually distinctive. I mean, they're distinctive. They're not mutually
Yeah, they're mutually exclusive of each other.
exclusive.
Correct.
Exactly. I was saying inclusive, mutually exclusive. But there's kind of like one thing that is driving it. So as a sensei of mergers and acquisitions, what do you think about my answer?
No, I think that was a great answer. I think that covers most potential scenarios individually for why somebody would transact.
Yeah.
I think just taking a step up from that, I think you have to acknowledge and understand that any one or more, or all of those things could come into the consideration when an acquirer is looking to deploy capital in that way. And I think that's where it has to start. And for us, when I was fortunately part of the team at Zynga, we started with a high level strategy that really didn't get down into that level of detail. But ultimately that strategy drove which of those boxes were checked. And as you all may remember from the Zynga times, Frank laid out a really clear strategy about the importance of forever franchises, right? And that was the North Star for the business, both in terms of resuscitating the organic growth through the existing products and also by finding additional growth through M&A. And that's why we focused on companies that created either games that were already forever franchises by Zynga's definition, or were clearly on their way to becoming forever franchises based on the metrics that we were seeing and comping those metrics against our treasure trove of data that we had from over 10 years of operating games ourselves. So whether those were category adjacencies, whether those were capabilities, whether it was talent, whether it was financial accretiveness, those things came second.
Mm-hmm.
And had varying levels of importance, but the main box to check was the overarching strategic fit of the target to what Zynga was pursuing on its own. And so that's where the 1 + 1 = 3 calculus always comes in, that I talk about in this forum, and also talk about with potential targets, is that it has to be that in order for it to make sense for both sides. You want to create long-term sustaining value for your employees, your new employees, for existing employees, for shareholders, and most importantly for players. And that's the other kind of driving force that's more philosophical, but ultimately is the overarching theme that should permeate all conversations. Because if you're not talking about those things and you're not true to your corporate strategy, and you're just doing, for example, financial engineering as the North Star, then that increases the likelihood that it's destined to fail, because you're not starting from, in my opinion, the right starting point for creating that long-term sustaining, lasting value creation for all the constituents involved.
That's a really great point when you when you talk about the forever franchises, because it's something that is easily communicated outside the company, but it's also easily communicated inside the company. And you said that there were clear KPIs that were set that would define what is a forever franchise. And it probably is a really good thing for a corporate development and M&A team, because they are literally executing against the only strategy that the company has, and not kind of boiling the ocean and trying to find something and then bringing back like, does this make sense? Does
Yeah.
this make sense?
You're
So
absolutely right, Mitch. You
yeah.
couldn't be more correct. I think for us, it created discipline and rigor around the kinds of opportunities that we filtered through the team, and meaning the corp dev team, before it even got to this committee, the decision making committee, which was just a couple other people in addition to my team. So that discipline and rigor and focus was what allowed us to move quickly, to be decisive, because if it checked that main box, and if the potential new addition to the team or to the organization felt the same way about the opportunity, those conversations could move very quickly. I can tell you that when I first joined Zynga, I, along with my team, did the exercise of post-morteming all the prior acquisitions that the company had did, and it wasn't great. It wasn't a great outcome. It was that 10-20% value, or sorry, 10 to 20% of the acquisitions drove the majority of the value. And in fact, the company had not recouped the money that it had spent historically in M&A between the time that it went public and the time that I got there. So it still had not realized that value. And I spent a lot of time when I first joined the company going around apologizing for the the behaviors of the past corp dev regimes, and really had to build up that trust and credibility and reputation, and being honest, being forthright, being transparent about our strategy and our view and our desires went a long way. I think the other thing, that just to share a quick anecdote, when you talked about where we started as a team and where we ended up, one of the most memorable discussions or interviews that I had with Frank when I was considering joining Zynga, he told me made this quote that I'll never ever forget, which he said, "Look, Chris, you should join here. If nothing else, we can't fall off the floor." And like, that stuck with me, because at the time, as your point, like, the stock was at such a low point that there was nowhere to go but up. If we just we're halfway decent at execution. And thankfully, Frank and the rest of the team that joined after I did, from his prior employer, we were all very clear. We were all on the same page. It was really, really well understood, and we were able to execute. And so that was a really interesting ride, the one that I think is worthy of business school case studies, to be honest, because for all of the great work that my team did on the M&A side to bring value, there was also a lot of great work that was done in other parts of the company that really may not have been as front and center publicly, but deserves equal, if not more, credit.
Yeah, 100%. I was there kind of before that, and during my 2 and some years at Zynga, I had, I think, 3 different CEOs and 8 different managers and 3 different division heads. So it was a lot of changes were happening at a very fast pace. So
seems like I follow in a lot of your footsteps when it comes to places to work.
True. That's true. Maybe you'll be podcasting one day. You never know.
You never know.
Yeah, there was a lot of things, and this is like really important notion, is that the company had a very strong North Star that was foundation of all the strategy, which is the forever franchises, and that seeped throughout the organization, no matter what the faction or the division or the line of work, whether it's probably HR, whether it's legal, whether it's the corporate development, everybody was really gunning for this one thing, and it kind of speaks volumes of Frank's leadership in the way that he's able to set that one North Star and not deviate to all the possibilities and opportunities that are spawning left and right. And that kind of leads to my question of lots of founders are listening to this and trying to collect nuggets. Like, Chris, just tell us, how do we sell our company?
Yep.
And so in this case, would you sort of recommend them to follow the news and kind of understand the strategies of acquirers so that they can position themselves against those strategies?
Yeah, that's a great question. I think I'll refer back to a really old adage, which could sound corny, but it does hold true. And they say that great companies are bought, not sold. And really what that means is that you should try whenever possible, obviously subject to the specific circumstances of your company, but that adage refers to the fact that you shouldn't be running a business with, being top of mind about how do I exit and how do I sell. Those kinds of opportunities and avenues become byproducts of great execution, great vision, great team, and in our case, great products and services. Mm-hmm. Having said that, I know that's refers to kind of a perfect world where everybody is firing on all cylinders, that there's unlimited access to capital, that there aren't existential issues in our industry. So understand that there are situations where companies feel like they need to sell. It doesn't take away from the fact that there continues to need to be a focus on execution and running the business. And I advocate quite heavily to anybody that asks that question to bring in trusted advisors around you, whether it's board members, investors, or strategic advisors like investment banks that specialize in helping companies do the things that they need to do in order to get them ready for a process. Because again, the more you as a founder, and Mishka, I know you probably experienced this, the more time you spend in the weeds of dealing with the back and forth of a potential acquirer, the less time you spend by definition managing your people, running the business, being responsive to your customers. And so bringing in advisors in exchange for the small fee, relatively speaking, that they get at the end of a successful process is well worth the investment, because it allows them to be the buffer. It allows them to be the liaison. It allows them to give you the blueprint on best practices about how to get a data room ready, what information to provide, what not to provide, what to put in your presentation. And they also provide those resources as well. And so ultimately the decision for when a company needs to be sold is a related question that we need to talk about, because that gets to this masterclass topic that we're here for. And again, another corny analogy, but I like to use the alphabet as kind of a frame of reference for folks that want nuggets. So the ABCs, we'll start with the ABCs. Mm-hmm. So for me, alignment through bilateral consensus. ABC, alignment through bilateral consensus. So what do I mean by that? I mean that it is absolutely essential for there to be alignment on a bilateral basis. Now that can be across many vectors. So let's start within a company. There needs to be complete alignment about the go-to-market strategy for a company as between founders and also as between investors, shareholders, if there are any. And you need to have all the cards on the table. You need to have all the discussions. You need to talk about all the uncomfortable topics that may come up, so that there is not, or you reduce the likelihood of confusion and disalignment in the future as the process moves on. And also there needs to be bilateral consensus as between the seller and the buyer, which is super important. I think, as I alluded to earlier in my comments, during my time at Zynga, we were extremely transparent with the founders. And it wasn't only myself and my team that they heard from. They heard from Frank. They heard from the rest of the C-suite and senior leadership. And they were very consistent. We were all very consistent separately in our messaging about why we were engaging, what our intentions were, what our goals are, what a success looked like, so that they could understand our desire and our vision and our strategy. And we also asked them the same question, which is what do you want? What does great look like for you from an outcome perspective? Are you committed to being with this business for a long period of time? What are your goals? How can we help? All of those things that you want to ask when you're in that dating phase, right? So that you get to know the other party as much as possible. So alignment through bilateral consensus, super, super important.
Those are really great points. I'm going to jump into the before alignment through bilateral consensus. You were talking about the role of advisors, which are incredibly important. So advisors, or bankers, as we usually call them. Now, this is not a paid ad for Areem, but I think those are at least one of the advisors. I think you worked with them on all 4 types of deals. So can you talk a little bit about how it is working with? Areem is a bank, right? They're a bank.
Yeah, Areem is an investment bank and advisory firm that represents companies on both the buy and the sell side. Mm-hmm. I was fortunate enough to work with Afan and his team on many of our transactions, not all of them at Zynga, but many of the transactions where they were the representative for the sellers.
Got it. And so that helps significantly the acquirer, because usually the seller is much smaller. And if you're an acquirer and then the seller has a very professional advisor, then that makes the process much smoother. and at the same time takes away all the headache because the seller needs to focus on, as you said, like if you're a small giant, if you're Peak, if you're Graham, if you're Rolex, you're focusing on shipping gains, you're focusing on maximizing profit, you're focusing on maximizing revenue, you're talking probably to several companies at the same time. And
Yeah.
that's where a company like Areem comes to play.
Yes, and Areem is one of many that I've had the
Yeah.
pleasure of working with, and we can feel free to list others
Yeah.
over the course of this podcast
Yeah.
if we like. But yeah, I mean, that is the role that they played, and that is the important role that a firm in that position plays, which is being that buffer, that liaison, that conveyor of information back and forth. And again, to your point, you as the buyer may think that you're the only date on the dance floor, but in fact, banks also get their, or earn their keep by virtue of making you available to other potential suitors as well. So if you imagine, multiply the inflow of requests from one company times 3 or 5 or 10, and that becomes a lot.
Yeah.
Especially when you're talking about dealing with smaller organizations that have 50 or less people, right? And most often it's much less than 50. And those people, need to focus on running the business. Obviously, they're going to get pulled in at the appropriate time to do things like unlock access to data, unlock access to financials, set a data room. But again, a lot of that heavy lifting and grunt work and collaboration is managed by it and is participated in by these investment bank advisors, because that's how they earn their keep is getting you ready, presenting you to a bunch of suitors, and then being that buffer so that they can control the narrative and the messaging and the flow of information and NDAs and data rooms. There's a lot of logistics that go along with this process that are super important, but also very time consuming.
Yes, very time consuming. So what are some key challenges that you've encountered in the M&A transactions, and most importantly, how did you overcome them from the buyer's side?
Yeah, I think some of the key challenges early on are getting that consensus that I talked about, and it's not so much from our side, but obviously, the seller needing to get consensus and from its constituents, and that is shareholders, employees, executives, investors, et cetera. And the more of them that there are, the more that you have to get consensus for. And in some cases, many of those folks wanted to speak directly to us as well, which is fine. But that ends up making the process a little bit longer, but it's obviously, the cost of doing business. I think the other challenges are the readiness of companies, especially early stage companies, to engage in a process. I've come across many companies that did not start from the beginning of professionalizing their back office, right? And I think that's a really important point to make to entrepreneurs and startups is that, you can't run a business with, Google Sheets and, and kind of more analog stuff that you need to, be very diligent about how you store contracts, about how you store your data, about how you keep your financials. And there are tools out there that are not expensive or difficult to learn. It's just a matter of, startups that are moving fast, that are nimble, that are just kind of at breakneck speed making product. They sometimes, neglect the plumbing, so to speak, right? The inner workings of the company. And it manifests itself quite a bit when you get into a data room situation with a potential seller and you're getting stuff that is, kind of garbage in, garbage out, right? If they're not very sophisticated in the way that they keep their books and records, it shows quite clearly. And that actually ends up being a consideration as part of your diligence process when you look at that and you say, wow, the company is this unprepared and disorganized. And maybe disorganized is better than unprepared because maybe they have not been preparing for very long to engage in a process. But, disorganized, not professionalized, not buttoned up in terms of their back office, that gives you pause at least to think about what does that mean in terms of how they're going to run the business, especially with being part of my organization where there's a higher threshold of competence that's required, either because we're larger or because we're public or whatever the case may be. So those were the big issues that I've encountered and one that I speak to founders about all the time about the importance of professionalizing your back office from day one.
Yeah, really great points. And the professionalism is easy to execute, to be honest. As you said, multiple different tools. It just needs somebody to be in control with the admin. So to all the founders that are listening, if you're back office, and by back office, like where do you keep your contracts? Who's your accountant? All these
How do you
things,
pay
who's your
people,
lawyer?
what's your HR benefits?
Exactly.
Yeah.
All these things, all the documents have them clearly in one place, just be professional about it, because when the opportunity comes, that will take so much time, and you need people to
Yeah.
re-sign different types of papers. And can't say that I've been there, but I've heard about these things that professionalism pays dividends over long term. And then the first part that you said, consensus, I actually wrote about this some time ago. I talked about it as an exit strategy, meaning that you are aligned in what is the exit strategy, and the exit strategy changes at different points as the market changes, as the funding changes, as everything changes. But this is something that you can quarterly or bi-yearly go with the board, and this allows you to say no to multiple different engagements, because over the time, M&A teams engage with you. They just want to have a chat. And then you know exactly like what are you chatting about, and you can be clear because you have a strategy, and this is the strategy at this moment. So you're not going to waste time, and especially go deeper with maybe more junior M&A team members, and start dating them without proper proper exit strategy. Let's put it this
Yeah.
way. So
Yeah.
so I absolutely agree on those two things. Really great points, and founders should keep that in mind. One of the things, like when I was reading about like why M&A deals fail across the
Mhm.
board, it's been mainly due to the post-merger integration and cultural fit between the two companies.
Yeah.
Now, when looking at your acquisitions, you acquired 3 Turkish companies and 1 Finnish companies. And when you think about the Californian company, when you talk about cultures, like I couldn't find more distinctive cultures than Turks and Finns. So can you please talk about like how did you assess the cultural fit? Because it's clear that the cultural fit is there since the companies have been so successful post acquisition.
Yeah, it's a great question. Let me get back to some first principles, and then
Mm-hmm.
I'll talk specifically about those examples. I will say to anybody that is willing to listen on this topic that I believe that within the M&A process, that the easier part of the process is the deal itself. The more difficult part of the process is the implementation of the integration framework and the administration of that going forward. And that is where the majority of those deals fail. When we talk about 80% of value being driven by 20% of acquisitions, it should be 100% of value being driven by 100% of the acquisitions if you're doing it right, or even 150% value if they're outperforming. And the reason is that integration is something that often gets overlooked and ignored as an important piece. In fact, when I came to Zynga, I was somewhat surprised to realize that I was not inheriting any kind of an integration framework or process that had been put in place by prior groups and prior regimes. And so I fortunately came to the table with one that I had built up over my career previously to Zynga. And I also had the good fortune, and Frank and the rest of the senior leadership that came from EA are also, will also tell you that they learned a lot from the do's and don'ts of M&A from their time at EA. And so they came to the table as we came together as a group with their own views about what they had learned and their own observations about what could have gone better. And fortunately for us, a lot of that kind of coalesced around the topic of the importance of integration. And for me, integration is not a kind of single monolith that gets applied the same way every time. Integration depends on the specifics of each deal. And more specifically than that, if you take the kinds of deals that I did at Zynga that are pretty normal in our industry, there are 2 types. One is where you just buy something outright for consideration upfront, either cash or equity or some mix. And it's basically an asset purchase, right? Where you buy a studio, you buy a company, and then you put that in as an entity within your organization that has been fully compensated over on day one for the value of that. The second is obviously more performance based, which we call earnouts, right? And earnouts come with them, and we'll get into this in more detail, hopefully. But earnouts come with it a lot more detail, some guardrails around the performance of that acquired business over a fixed period of time, and the associated rules for that performance. Now, for earnouts, integration is much different than when you're acquiring an asset, and we experience both, and we fortunately were able to do both really well. The reason why earnout integration is different is because it by definition requires a lighter touch, and the reason why it requires a lighter touch is because you have contracted with the seller on terms that basically say you, the seller, will get an additional payout over the course of a fixed period of time if you hit benchmarks A, B, and C, right? And the reason why earnouts come to bear in the first place, which I forgot to mention, is, in many cases when you're talking about a company that is on a growth trajectory, they have a certain perceived value of themselves, right? Which they have a right to. And some of that perceived value comes in the form of their belief in the likelihood of future success, right? As a buyer, I only can ascribe value by definition to what I see in the market that's generating data, because as we know, current success does not necessarily translate into future success. So, if I want to buy your company, Mishka, and you say, "Wow, we made $100 million this year on this one game, and we have 2 in the pipeline, and we're going to double the revenue for each of those 2 games successively on top of the first one because we learned here, and now we're going to apply these learnings, and it'll be a home run +2. So that's what you should pay us." And I would say in return, respectfully, Mishka, I'm willing to pay you for what is currently in the market today, but I'm also willing to compensate you through an earnout of what you believe you're going to achieve over the course of that period of time that these next games come out. And so for us, it was actually a great starting point because, as you know, when you engage in these kinds of processes, the seller provides their projections and the buyer looks at those projections. And the way that you create or connect that delta in valuation is that you say, great, if you believe your projections, I will pay you based on you hitting those projections, because if you hit them, you'll be happy. If you hit them, I'll be happy because I know that it's going to create X additional value for my company. And so the challenge with earnouts is that it creates guardrails by which you need to manage that business between the time that you get bought and the time that your earnout period is over. And the last thing that you want to do is be in a position where you feel that the acquirer is impacting your ability to deliver and execute against that earnout strategy, or just how you believe is the best way to run your business. So by definition, you as the buyer want to be as hands-off as possible. And we took that approach. For us at Zynga, for earnout-based deals, it was do less to do more. That was the mantra. And the way we approached it was that we provided each acquisition with the menu of services that Zynga could provide. And we did it for free, by the way. I know some other companies do like intra-departmental reimbursements and things like that. We offered it all for free, no strings attached. And we said, here are all the things that you could benefit from if you would like. We started with a very small requirement because Zynga, as you guys may remember, was a public company, independent on its own. And there's certain reporting requirements that you need from a financial and audience perspective. We required those 2 things to be mandatory delivered to us so that we can roll those up. But beyond that, everything else that we had in those menu of options and services were opt-in. And that's the key part, is that we gave Graham, we gave Small Giant, we gave Peak, we gave Rollick the same list, the same menu, and said, here's what we can offer you. Pick some, none, or all of them. It's up to you. And we wanted to make it their choice. And during the course of us getting to know each other, we would constantly show the value of how these services manifested themselves in other parts of the business as a way to say, in case you were wondering, our data science team was able to accomplish XYZ. Our central product management team was able to accomplish ABC. Our accounting, finance, HR, legal was able to do XYZ. And it provided a benefit and a value to Zynga. And if you want to avail yourself of the same thing, let us know and we're happy to help. So the first thing, obviously, a lot of these companies do is they raise their hand and they say, I want to offload all of my back office stuff because I want to just focus on making product. I don't want to hire legal. I don't want to hire HR. I don't want to hire tax, financial, accounting. I want you guys to do that. Great. And then at some point, as you know, each company that making new product or running live product runs into an issue. And we were always there to answer any questions that they had. And if the questions got serious enough, we would offer up resources to go in and help triage the situation, provide learnings, do a postmortem, and then leave. So the reason why I bring this up is because we have too many examples in our industry and others where acquired entities are asked to be absorbed into the Borg in a way that is counter to their culture, counter to their own brand identity, counter to the way that they've built their business, and not actually additive to the 1 + 1 = 3 calculus. So integration is very important. That requires fine-tooth comb execution on a deal-by-deal basis based on the circumstances of each deal and what has been agreed to between the parties.
That's really interesting. I've never actually heard about this type of a thinking where you have two different types of post-merger acquisition processes and really based on the deal structure. And I assume that with an asset purchase, you just basically absorb the asset and it functions just like all the other assets inside the corporation.
Yeah. So great example going back to Peak. We
Hmm.
acquired two parts of Peak. We acquired
Hmm.
Peak in two
Oh,
parts, I
yeah.
should say.
The
One was the
games.
board and card studio that became Zynga Turkey, and that was an asset purchase from Peak to us because they had deemed that studio was no longer strategic to what they were doing. And for us, we wanted to be a leader in the board and card game business based on Words with Friends and Zynga Poker, and we wanted to
Hmm.
double down
Hmm.
on these evergreen products. Again, based on a corporate strategy. We loved the team. We loved where they were based. We loved the products that they made, and we loved their potential to be able to create new products. And they were an asset purchase. They got rebranded to Zynga Turkey. The GM of the Turkish studio became the head of that studio. He became part of our inner kind of communications and phone calls, and it was all Zynga email addresses and all the access through the through the intranet and all those kinds of things was availed to them early. Whereas when we acquired Peak, the second half of Peak, the main part of the business, they stayed independent. They still are under the Peak brand. They opt in or out to whatever they want from the Zynga menu, and that's treated. Even though, by the way, that was not an earnout based deal, but
Hmm.
still they earned their way to independence by virtue of how big they had gotten and the scale that they had achieved. And so we treated that also quite lightly because they demonstrated that they were able to generate success without us, and we didn't want to actually hinder that in any way. We only wanted to be able to provide incremental value where they saw fit.
That's really cool. Yeah, like going through all the acquisitions, like that was the type of a thing that we're always talking about, even on the podcast, how they stayed autonomous and how Zynga is doing it right, and some other companies were doing it wrong, according to Chris. Uh, but talking about like going back to the original question, like how do you assess the cultural fit between the companies?
Yeah, I think the cultural fit is something that you spend a lot of time on the front end. And I
Mm,
alluded to it earlier about we spent top to top time between the founders, our C suite very early. Once we got the internal consensus that this was an asset that was of strategic interest to us and good fit on paper, then the next important part, or the most important part, was making sure that the people that we were going to be partnering with were like-minded, that they believed what we were saying, and that we could also tell them that we were going to deliver on what we said. And so spending a lot of interpersonal time. And I was fortunate enough in that most all of these deals, I think up to when we were closing Peak, were done post-COVID. So we were able to more
mm.
freely travel, spend time. We were in Istanbul. We were in London when Graham moved to London. We were in Helsinki with Small Giant quite a little bit. And we actually also would fly them out so they could see the broader organization. And again, not to the detriment of running the business. We're very selective about how many people we sent, when we sent them. If it was around a conference when they were already traveling,
Mm.
so be it. But we were very nimble and agile in getting on planes to go spend time up front, because again, the dating analogy works here. You got to put in the work on the front end in order to feel like it's a great match, because this is meant to be a long-term relationship that hopefully will generate value over time, and you want both parties to be happy so that they're invested, engaged, and retained. And so really it's just asking all the questions, providing all the information, just like you would on a date, so that you make sure you know that person or that entity as much as you can going into the process, as opposed to just thinking that it's all just on paper and the interpersonal stuff doesn't matter, because I contend that matters much more.
It matters a lot. Like, of course, human connection when you're making a deal, in any deal, matters a lot. And the second part that matters a lot is the reputation of the acquirer. Like we had the situation where Peak was contesting for Rovio, and of course that's a public company acquiring another public company, so everything was public, and there was a lot of negative consent in the media and inside the company of not wanting to be acquired by Peak because of their two other acquisitions in the country that didn't go as planned.
You mean
The
Playtika? I think you mean
play. Oh,
Playtika.
sorry, Playtika. What did I say?
Peak.
Peak. Oh,
You still
sorry.
have
No,
Peak on the
no,
brain. Yeah, yeah.
no. Peak. Yeah, I have Peak on my brain all the time. but no. Sorry, I was talking about Playtika. Yeah,
Yeah.
so Playtika's acquisition attempt of Rovio, and they had acquired previously WeWorks and Seriously,
Seriously,
and
and
those.
Muga, and Buffalo
Yeah,
Studios, and but
yeah.
there's a long history there of.
But specifically the two studios that were in Finland, and due to that, they had a little bit of a negative consent because they closed one of them, and the other one is kind of a not in such a growth mode that it was before the acquisition. So the reputation of the company as well as how nice the people in the M&A team matters a lot. And that leads to my question of like, what is a work week of an M&A team? Like when I don't think you have typical because you have to travel so much,
Yeah.
but what do you guys do?
What do we do? Yeah. So we spend a lot of time in the data. We
Mm-hmm.
were fortunate enough at Zynga and everywhere that I've been, one of the base requirements is to make sure that we have solid data flow of information of what's coming from industry that is everything from how games are performing, which ones are moving up the charts, looking at the top download list, top grossing lists, globally across platform, et cetera. Also just playing a lot of games. I gave each of my team members at Zynga $100 stipend per month to be able to spend in-game currency across any games that they wanted, so that they didn't feel constrained by that output of cash, so that they could actually get into the games and understand what the monetization looks like, what the community feels like, what the gameplay looks like, and provide their own feedback. That was one of the things that always was top of the list of things that needed to be brought to the table whenever we were doing these consensus-based discussions about whether to pursue a target, was that there need to be multiple people in the room that played the game, that could give a consumer perspective as well as a product, feedback perspective to the team. Obviously, we didn't expect Frank to play every game, although surprisingly, he played more than you would think. But we had, myself, Bernard, Scotty Koenigsberg, the rest of my team. There was a whole bunch of people that were, avid game players and came to the table with a lot of opinions. So that's super important. And I think also just fielding, the number of, I think on an annual basis, the number of companies that were part of our database was probably 300 to 500 a year, which was either us outreaching, getting outreach from these companies or their advisors, or just meeting them in the course of travel. And we added every one of those to our database and tracked them accordingly so that we can make sure that as team members interacted with these companies, that we had a record of who spoke to whom and when and about what. And obviously, if we added or subtracted team members over time, that they could also look at that and get up to speed. Because to me, the worst thing that can happen is when you have a company speaking to each other through multiple channels, but they never make the connection that there were prior conversations. It just makes it look quite unprofessional. So we prided ourselves on having good tracking systems, make sure that we did that as much as possible. And then just a lot of analysis, a lot of market data analysis, a lot of company analysis when we got their information, and a lot of decks, man, a lot of PowerPoints that we put together for internal consumption, board decks, committee decks, all that kind of good stuff. So it was quite labor intensive, both from a travel perspective as well as from a interpersonal perspective, but also from a data and work product perspective. And we were only at my largest, the team was 4 people. Like that was including myself. So it was quite a small team.
How did you end up making so many deals in Turkey? Like, was it just like the appetite grew as you came to Istanbul, was it
so
same
it's
investors?
a great story. Yeah. I don't think we had Turkey specifically on our radar until we started seeing the data from various game companies. And there was a couple things that happened at around the same time. When I joined Zynga, I had the good fortune of having a longstanding previous relationship with Sidar, the founder and CEO of Peak, from before my time at Zynga. So we were always keeping in touch. I was always keeping tabs about how his company was doing. And it was obviously quite known that they were one of the few companies that made the successful pivot from web gaming to mobile gaming. And then how they were able to build 2 amazing franchises with 100 or less people was quite inspiring. And so that was known. So through that kind of known filter, then you start, peeling the onion back and looking at that market and seeing other signals of success coming from that market. And Graham was one of those games. If you may remember, the first incarnation of Graham was actually making kind of the switcher puzzle games, right? Like the 2047, like the more kind of, casual, what we now maybe call hyper casual games or, casual puzzle games. And they were all in Turkey. And we had said at the time that they started a process with Areem during kind of version 1 of their company. Mm-hmm. And we respectfully declined and said, hey, look, we love you guys. We like the direction that you're going, but we want to see a little bit more of this manifest, because at the time we talked to them, they were transitioning from making these casual games in Turkey to moving to London, moving from ad-based to IAP-based with their merge mechanic. And so this was before they executed. And thankfully, we did not pursue it, because I think we would not have Graham would not have become what it did if we would have got intervened earlier on. So better lucky than good sometimes in our decision making. But we told them, we'd love to stay in touch. We'd love to give you 3 to 6 months to get yourself settled on this new business model, this new genre focus, getting settled in London, making sure that we see how you interact with your team back in Turkey, how that works. And 6 months later, we kept playing their games. We couldn't stop talking about their merge game. We got really excited. We met their lead designer, who happened to be based in the Bay Area. And then we really quickly, because we had built that rapport over the last 6 to 9 months previously, when we came back to them, we were very clear about how we felt about their business, about where we thought we could help, about what we wanted to provide them in terms of a long-term opportunity. So that was very, very quick. And then over time, through my relationship with Sidar, the broader Zynga organization got to know him and the team quite well through our travels there for Graham and elsewhere, and otherwise when they came to the Bay Area. And again, there were some really unique circumstances surrounding Peak's business that I'll defer to Sidar and his team to talk about because those are that's for them to discuss. But basically, there were a set of circumstances that necessitated them to make a decision about selling when they did. And fortunately for us, because we had built up such a rapport and relationship, Sidar and team were not interested in engaging with anybody else besides us, which actually was kind of a de facto exclusive environment that was organic. It wasn't something that we mandated in writing. He basically just told whoever would listen on his side that, yes, we will sell, but we will only engage with Zynga. And if it works, it works. If it doesn't, it doesn't. And so we were a very lucky beneficiary of putting in that relationship work in the months and years preceding that deal that allowed us to consummate that relationship, quite quickly, and in terms that both parties were more than happy with.
All right, I wrote some pieces for those aspiring to be great M&A team members, and one day maybe heading an M&A team. So as a person, you need to understand the market. That means using your data AIs, using whatever you can read and listen to Twig maybe sometimes to hear about how the market is going, different opinions, different views. That helps you with the communication to the higher ups and setting up your strategy as well. The second part is play a lot of games. This is super important because those allow you to have the right type of conversations with the teams you're meeting. They will respect you more because they are game makers and you are on the business side. But if you come in and you can speak the same language, you've played all these games, you've progressed so far because your boss has been giving you $100 every month, the level of conversation is going to be totally different and they're going to like you. And that leads to the networking part. So you have to network a lot and network in a right way where you set up not a lot of like meetings where you meet a lot of people, but when you understand who are the people you want to set up a great relationships with, who are going to peel the onion for you, as you said, allow you to connect to others and somebody who doesn't maybe need your help right now. And so like you might have a very sort of a mutually beneficial relationship. And that will lead to a lot of great cooperation over time and possibly even a deal with that person as happened with Peak. And then the final part, as was with for the founders, is professionalism. So, the companies you connect will just like you connect with the companies and you think they're unprofessional when they don't have their back end together, the companies will think exactly the same way about you as an acquirer. If a third person from your company sends an email like, hey, we should meet up at this thing. It's really cool. We've been playing. It's like, I just talked to 2 others. Like what is going on over there? Like, do you guys even have a conversation? So those are the kind of like the four factors that I picked up.
Yeah, I would say those are spot on. And I also think we benefited a lot from actually living up to our word when we did some of our early deals. And the founders of those deals, like in Graham and Small Giant, actually became advocates for us. And spoke from the perspective of founders to the community. I think they actually did some interviews with folks like GamesBeat and others where they actually talked about their experiences, and they were not shy about holding back about places where they felt we could improve, and we took that feedback and applied it in the future. But I do think that when you have the advocacy of founders who can say, yes, everything that they told me, they delivered, and it's been true, and there's been no tricks, there's been no hidden agendas, there's been no bait and switch. That goes a long way to fellow founders hearing from them versus hearing from me, right? And obviously, the proof has been in the pudding in terms of how these games and these deals delivered. But ultimately, for us, we were the beneficiaries of these founders being advocates for us, and it actually just organically increased inbound deal flow. So we actually ended up having to travel less in the first instance because we became known as a fast-moving, honest, organization that could make decisions quickly, that paid fairly, and that provided the latitude for founders and studios and companies to maintain their own culture, their own identity, but benefit from the perceived synergies that a larger company could provide.
Yeah, it's the same thing as with almost with hiring strategies. Like when you hire a really good director somewhere, that director will bring in other people who he worked with or she worked with, and who's known in that cluster of whether it's the craft or whether it's the location. The same thing with these acquisitions. When you make a good acquisition, might not be the biggest one, but you're executing well against it. The people who joined your organization like it, they talk positively about it, and suddenly they will introduce others who they think are also great to you, and that kind of pays off. So do every acquisition properly,
Yeah,
and
look,
that
I
will
think
lead to many deals.
our deal with Rollick was
Yeah,
directly benefited by virtue of the positive experience that Graham and Peak had with us.
yeah,
And they asked a lot of questions outside of us. They did a lot of diligence. They spoke to a lot of their colleagues in Turkey, as they should. And I think it gave them a lot of comfort in knowing that they were going to be going to a place that had their best interest, that could provide them with growth opportunities and be able to support their vision. And I think you've seen a lot of that with Rollick. Rollick has grown into one of the largest hyper casual publishers. They've made acquisitions of studios with Zynga and Take-Two support, which was always part of the vision and plan. And so to be able to provide that as a platform for them to execute on their vision, was just another great outcome of just a diligent approach to how this partnership would work.
yeah, 100%. Before I jump into the fan questions, we have a few of those. I wanted to end this part of the masterclass in the most open-ended question, which is like, what are the trends you're seeing in the current M&A landscape in our industry, and how do you think those trends impact the deal strategies and the structures going forward?
Yeah, I think it's been interesting to see the way in which the M&A landscape has evolved, especially post IDFA. I think there was a much larger and higher velocity of large scale deals, right, that happened post IDFA, and maybe even bleeding into IDFA with Take-Two and Zynga. But EA did a bunch of acquisitions on the mobile side. Obviously, Microsoft with Activision, that kicked off, if I believe, that they started talking with each other well before IDFA. King is always like one of the OG, kind of cross-platform acquisitions that has withstood the test of time. And there was always this talk about consolidation at the top, right? And I think that the Microsoft and Take-Two deals were the culmination of that. And interestingly enough, but maybe not surprisingly, we haven't seen a lot of that kind of top-down M&A where there's been consolidation at the top with large-scale companies merging or merging into each other or becoming partners. And that's obviously been because of the uncertainty in the mobile space, because of valuations, because of access to capital or lack thereof, because of the cost of capital. There's just been a lot of factors that have impacted the velocity and the size of M&A deals. I mean, I think for any of us that get the reports that we get from investment banks or from Game Invest, you see the velocity and the dollar numbers are much lower than they used to be, right? You used to see like 20 deals, $3 billion, and now it's like 5 deals, $100 million or something like that, and you're just seeing it not happen as much because buyers are in capital preservation mode and sellers are not necessarily in a position of strength, either from a valuation perspective or from a portfolio performance perspective, to be able to command the highest outcome that they desire for themselves. So I think we're at a little bit of a limbo stage right now until those kind of factors get closer to each other, until the recession is fully at our back, until the markets calm down a little bit, cost of capital goes down, valuations maybe go up or normalize, depending on who you ask what the right term is. And I think outside of gaming, you're going to see, consumer internet IPOs, e-commerce IPOs, et cetera, coming to market here in the next couple months. And I think that'll be a telling sign for the broader consumer tech industry about how the market views these sectors. I think we all can agree, because we're in the business, and even though we may be inherently biased, I think we firmly believe that the medium to long-term viability of gaming there's no question about it. It's always going to be the largest sector of entertainment. Mobile gaming is always going to be the largest sector of gaming. and that there's still tremendous growth opportunities either in audience and geographies and platforms that is still to come in front of us relative to being in other entertainment categories. I think is a lot harder of a sell these days than being in gaming. So I think the M&A ebbs and flows with the macro. And I think my hope and prediction is that starting in the first half of 24, that we'll see some return to normalcy. Maybe what we'll see though is acqui-hires, maybe roll-ups of a smaller scale. So people starting to get back into it, starting to dip their toe in the water, but doing it from a smaller risk profile perspective. And then once we have like complete or near complete kind of stasis or security or stability in our markets, pretty predictably, then you'll see the big guys start coming in a little bit more because they'll be bolstered by that predictability and stability. But in the meantime, I do think that we're going to see a lot smaller scale, a lot more velocity on the smaller end of the scale.
Clear. So less M&A, smaller size. Reason being the capital preservation, despite the fact that you could now get a lot of good deals compared to the crazy years of 2020, 2021, early parts of 2022. There's a lot of companies doing, startups doing down rounds, so that helps you with any kind of acqui-hires. There's just companies whose valuation just has decreased because they might be mobile first, and mobile is not that hot anymore, and then you can make a good acquisition there. But I understand from the corporation side, they don't want to make any mistakes, and so they're just going to rather sit on their cash. And it's not even sitting on the cash because of the high interest rates, that cash is actually generating revenue. So so that also pushes company to preserve capital because it's producing.
Yes, agreed.
Okay. All right. Well, fan questions then. So
all right, let's get to it.
Number one, beyond the obvious financial metrics and KPIs, what are some less tangible factors that Zynga considered when evaluating the long-term value of an acquisition?
Yeah, I think it really came down to what we were talking about earlier, which is the people, and what is the quality of the team that was operating at the time. Had they worked together before? Did they have success and failure together? Have they applied those successes and failures to their future business? And do we see them being a natural fit within our organization? Because again, we lifted the kimono enough for them to be able to see the inner workings of the company so that they could feel comfortable that this is a place that they could call home. So it really is the interpersonal relationships. And going back to that corny dating analogy, is that the dating part, we put in a lot of legwork because we wanted this to be a long-term relationship. And so really that making sure that it's a fit, that people are not just in it for the payout, that should just be a natural outcome of great execution and great partnership, especially on the earn-out side. But we've also seen that, even with the best intentions, that money can change people's perspective about how incentivized and invested they are in continuing to put in the hours and the work to grow and maintain a business. So these are things that you can never really completely control, but you can do your best to get a good gut reaction based on your interpersonal experiences with those folks over time about what kind of people they are, and whether you see that they have the ability to lead regardless of the conditions, and that they are invested in making great games for a global audience at the end of the day, and not just in it for the payday and then leaving.
So in a way, you have to be a little bit of a people person, not in a little bit. You have to be a total people person if you're working in M&A.
Completely.
Okay.
Yeah, which is ironic because the core engine of M&A is analytics, right? And numbers based analytics and financial analysis, but ultimately the people aspect of it is supremely important.
Yeah. Yes. Then two questions from I'm going to mention who posted this. So Louis de la Camara, he's Rovio's VP of Marketing. I know he loves the shout outs. So shout out Louis for long ended, because Louis is from Spain. I mean, half Spanish, half American. Long-winded questions. Let me read the first one. Where do you see the end game for consolidation in gaming? Will we look like the auto industry or beer industry, where there are a handful of conglomerates, each with various brands under their roof? If so, how quickly will the market look like that? If not, what will the market look like in a few years' time from consolidation standpoint? Great question.
Wow, that's a great question. So I guess it depends on the way in which you define consolidation, because if you look at it by sector or by platform, you could argue that the console PC space has been consolidated for quite a long time, right? You have these conglomerates or large companies that have been traditionally AAA focused or AAA first, EA, Ubisoft, Take-Two, Activision, and those are kind of like the ones, Square Enix, those are the ones that just come to mind that are public and large. There used to be a lot more, and now there are less. And I think that took, 30 plus years to get to the stages where there was kind of a small group of consolidators and market leaders. If you look at it from a mobile perspective, the consolidation has already started as it relates to these incumbents buying into mobile, right? So they've consolidated a lot. But in terms of those of us like my company that are independent, I think that we will look. There's a possibility that we will look like the AAA space. But I actually think that what's going to happen more likely is that because the way that the market is going is such that platforms matter less, right? As we're getting into this age of anytime, anywhere, any device expectation of consumers for games, it's not going to be mobile versus PC console. It's going to be about who owns the best IP, who makes the best games that can be played across a myriad of devices and platforms, and what does that IP portfolio look like? So I think our industry ends up looking a lot like the entertainment industry, which is the big studios, the Disneys, the Sonys, et cetera, that own a lot of different subsidiaries that have complementary or unique skill sets or value propositions, but ultimately drive to a singular strategy, which is to provide the best interactive entertainment experiences to consumers around the world. So I think, and we can talk about this more at a later date, I do think that the emerging conglomerate game companies that get it right will basically be the next generation entertainment companies, because I happen to believe that the next Marvel and Star Wars will come from a game company, because that is just where the digital native generation is starting to first interact with and get affinity for IP. They're doing it through games. They're not doing it through going to movie theaters. They're not doing it through watching linear television. So I do think that there's going to be a conglomeration of game-centric entertainment companies that will take their place in the kind of pantheon of the entertainment landscape. And our industry will look a lot like the entertainment industry, with, kind of the big corporate, structure, but then discrete studio portfolio underneath that are very focused on certain genres or different audiences or different platforms. But ultimately, the IP and the content and the consumer is what matters the most.
Fantastic vision. And do you think that the production will also remind a little bit of that is happening in Hollywood, where you have a multi-studio approach and everything is much more flexible, where you have those IP holders, the big studios, and then they just leverage different professional studios to help them to deliver those entertainment products?
Yeah, I think that's part of it. I also think that because we're so diversified in our industry in terms of the genres, the platforms, the business models that consumers expect and demand, that there'll be a lot more variance in that approach, and have that expertise will be really distinct. And there'll be hopefully synergistic, interworkings that happen within a conglomerate where studios and organizations will help each other out based on what their area of focus and expertise is. Like, for example, to use a Hollywood analogy, if you're a big entertainment company and you own a studio that specializes in horror films, that studio is not going to be helpful when you're creating, romantic comedies, right? Maybe not so much on the output, but maybe in the process of, leveraging technologies, or, how you work with audio, or how you work with, cinematography. Those kinds of things I can see also applying in next generation game companies as well.
Awesome. The second question from Lewis: when you look back at the various deals you made and how they have evolved since then, which do you feel over time has proven to be the biggest success, and which do you feel has proven to be the biggest failure? With hindsight, why do you think that is, and how does that compare to your thinking at the time?
That's a great question. So I would say, the answer depends on the time frame that you're looking at it. When you do deal models generally as an M&A team, you're forecasting out 2, maybe 3 years at the most, and your forecasting gets a little bit iffy, and less precise, anything outside of the next calendar year, because you really just, especially when it comes to new products, right? And again, going back to one of the things I said earlier in our chat, is that I never ascribed any value in my deal modeling to future products. Never put any kind of handicap on it, never gave it any chance of success. It was always a 0 for me. And again, it wasn't personal. It was just, I can't ascribe value to something that doesn't exist, other than just as an idea on a PowerPoint. I just can't. That would be irresponsible financially to do. And so all of our deal structures and valuations were based on what we paid on day one for the current trajectory of the business, and then what we gave as an incentive to pay out over time should these new products get released and achieve the level of success that were in the seller's forecast in the beginning. So I think all of the deals that my team and I did during my time at Zynga had tremendously outperformed the deal models within a relatively short period of time, well before the 3-year period. So I think from that perspective, they were regarded in my mind as quite successful. I think obviously the one thing that you as an M&A team or as a leadership team can't control is whether future products are successful. And now, we've seen that Graham and Small Giant and Peak and others have had, not as much ease of getting new products to market as their predecessors. And that's not unique in our industry. But it also goes back to what I said earlier about the risk mitigation by virtue of not giving them value for that unless it's actually been earned. So from my perspective, nothing lost in terms of financial, return by these games not being as successful, because they were also running successful franchises, forever franchises as they turned out, right? That are great annuities. And then all you can do is just hope that they learn from that and their next products end up being more successful than the previous efforts. And that's just the nature of our business. So I don't see any of them as having been failures. I think the one that I would say, believe it or not, the ones that we didn't talk about, which were the first two that I did, one was we acquired a company called Puzzle Social that did a daily crossword game. That was my first deal. And then we acquired a solitaire game that was an asset purchase. And those were below $50 million. So quite inexpensive in the scheme of, the $3 billion plus that we spent over my time there. But those ended up being not as great performing because those were the first ones that we did as a team and as a leadership team together. Thankfully, we started on the smaller end of the cost scale, but we learned quite a bit from those smaller deals that helped inform us on the larger deals, that everything from Graham through Wildlick ended up being quite successful because of those learnings. So I would say those failed for a number of reasons. I think number one was, the original thesis may not have been spot on, or in one case with the solitaire game, the team that took over that asset tried to innovate too much on a very simple game and really kind of innovated its way out of kind of being an evergreen product and trying to put too much into it. So we learned a lot from those. Obviously, the people that sold those businesses still got paid, and we absorbed, some of the employees in many of those cases. But those are the ones, Puzzle Social and then the solitaire game, while they returned, didn't return nearly to the scale that the larger deals did.
But then I wanted to kind of zoom back to understand those failures, but I wanted to kind of zoom back on everything you've told. You're so professional with this. You have such a great insight. I'm learning a lot. How did you learn all these things? Is it through failures? Is it through looking through other people's failures? Is it by just because usually you either win or you learn. That's what I've noticed.
Yeah, that's right.
So where did you learn all these things? Why are you so good at M&A?
I think, sometimes it's luck. I mean, sometimes you're surrounded by great people and you're put in a great circumstance where you have a platform for executing against what you feel is the vision. And I think specifically at Zynga, at the time that I came in, and the faith that Frank had in myself and in the process of actually generating inorganic growth for the company through M&A, because we were blessed with having a strong balance sheet and we were a public company that could use equity as consideration. Like we had tools at our disposal that allowed us to deploy those tools in a way that was unique to other people or maybe advantageous relative to other companies in our space. I think many of us, myself included, came from prior experiences. I alluded to the EA experiences that my colleagues had before they joined Zynga, my experiences at Kabam and at GameStop before that, and even at Playboy of doing M&A. A lot of learnings there, including, like we talked about a little bit about the integration framework that I created over just time and experience of doing deals and seeing where things went right, where things went wrong, and then creating a playbook for myself that I could use going forward. So like you said, you learn a lot, especially in failure, but you also learn a lot in success and you try and double down on that success. So it really just is the benefit of experience, going through the bumps, taking your licks and your bruises and just getting up and trying to do it again, and always being honest, always being transparent and always being perceived as a partner.
Yeah. And humble. because that's the key of learning. But yeah, you like that's important also to understand that you have a quite the history before Zynga,
Yeah.
Kabam, GameStop, and so forth. So it wasn't like coincidence that's where everything culminated, and you were able to make such a $3 billion streak or $4 billion streak of
Something
good
like that. Yeah,
acquisitions.
yeah, yeah,
Yeah, so it's like it's definitely not that your current role is not a culmination of everything prior, but that was kind of like the culmination of M&A work. Last one.
yeah.
This is the spiciest one. So I'm going to end on this. Zynga's acquisition by Take-Two. Would Chris agree with Eric Kress, meaning that Eric Kress has said that Zynga's acquisition by Take-Two, I'm paraphrasing, Zynga's
Yep.
acquisition by Take-Two is the worst acquisition in gaming history.
Hmm. Yeah, I remember that. That was one of the podcasts I was listening to on my hike, but I wanted to throw my phone off the mountain. So look, Eric and I work together at Kabam. I love our angry uncle here of Deconstructor of Fun. I think everybody loves it, and this is the kind of stuff that actually creates great conversation. Look, I think that observation can be had at any moment in time for any kind of deal. I think Zynga was a recipient of, or I guess Take-Two perhaps was the recipient of unfortunate timing of their deal relative to the early stages of IDFA and the industry not really knowing what the full effects were going to be, and maybe not taking that risk into account as much. And I don't know that anybody outside of Take-Two would have known any better or different, including any of us in the DOF community, would have been able to handicap what that really would have meant. The ironic thing is that all of the impact that Zynga had on IDFA was born out of two things. Number one was the fact that it was the first public company that was honest about the impacts of IDFA. I think, as you remember, like many other public companies were punting on that topic and not wanting to talk about it, whereas Zynga did. And I think Zynga was unique because it had so much exposure and access to the impacts of IDFA on both the positive and the negative side by virtue of being a spender of UA dollars, a recipient of marketing dollars in its ad-based businesses, and also owning an ad network, right? So they saw it from so many different angles that I think in the near term that may have disproportionately impacted them negatively. I think ultimately that's going to be a strength because they'll be able to diversify their risk across all these different touch points as we get more clarity around what it means to operate in a post-IDFA, post-privacy manifest, post-Google privacy world. I think the companies that have these multifaceted entry points into the marketing landscape will ultimately, thrive and be fine. And I think, look, this is not an asset that Take-Two bought that was meant to be disposable and have a shelf life. Mobile is supremely important to Take-Two. The mobile business generates close to half of the revenues of Take-Two, and creates the potential for steadiness in a business that's otherwise quite up and down and lumpy, right, with its long cycles of its tentpole franchises. So I think that provides really great hedge for somebody like Take-Two. And I think if you were to look at the more optimistic side of this, that having a leading mobile company inside of its four walls that can help deliver on new products, especially when it comes to opening up the coffers of the Take-Two IP portfolio, that is something that can create tremendous value. And obviously, if I'm Zynga, I'm clamoring for all of the IP. And if I'm Take-Two, I'm going to say, well, okay, before you get to the ground jewels, you got to prove yourself on these other IPs that we have in our portfolio. But I think if I'm a company that has unfettered access to a portfolio, IP portfolio that's the size and scale of Take-Two's, and I get it for free, that is tremendously valuable to me. And I think that they have the opportunity to create that value. There's always the question about whether Zynga is the right company for that. And I keep reminding people that a company is never static with the current capabilities and people that you inherit, that morphs over time and molds itself to the needs of the company, right? So if they don't feel like they have the capability to make a Red Dead Redemption cross-platform game and be the mobile component of that, they'll go get it. I have no doubt about that. And I think that, the company is filled with great leaders, whether it's on the Zynga side, whether it's, on the Nordeus side, whether it's any of the other studios, they are leaders, and they have proven to be leaders, category leaders across multiple genres, and hopefully now across multiple platforms with Take-Two's partnership. So I don't think that over time that Kress's comment will withstand, but I think at a moment in time when he made it relative to IDFA and relative to the performance, the near-term performance of some of Zynga's portfolios. I think he was right to be critical of it. But again, I take a long-term view. This to me is not a disposable, product that you buy and then it expires. This is something that has perpetual value that you keep trying to unlock over time.
Yeah, and Zynga has proven to make that difficult transformation going from web business to mobile business, and not just transforming, but becoming one of the largest publishers on mobile. When you think about their games,
yeah,
exactly. And when we think about their
M&A, right? Most
yes,
of it driven by M&A.
Exactly.
So just to bring it back full circle.
Exactly. And there's everything from Natural Motion to Peak and Rolex. So all kinds of different games to Small Giant. So there's definitely I would agree on the long term view, and I think Eric would agree as well. We have the rule of like now saying this is not going to work in 5 years. Like let's put a cap on AR and VR and the cloud. Let's just talk in 5 years.
Exactly.
5 year sentiments rather than the forever. But well, listen, thank you so much for sharing all this knowledge. It was I think
thanks for having me.
I think this will be very well received. And so if you have any questions, Chris, about M&A, just listen to this podcast. And if you still have questions about M&A, you can probably find him on Deconstructor Fund Slack channel. You can try LinkedIn, or you can try some of the events, and especially the events hosted by Areem. that's where you can definitely find Chris.
If they keep having me,
yeah. Well, after this, I'm sure they will. So shout out to Areem. Good advisors among many. Let's put it this way.
That's right.
Thank you again. 1,000 thanks, and thank you everybody for listening. Till next episode.